Working capital. Working capital serves as the lifeblood of any business, facilitating day-to-day operations and sustaining liquidity. Effective working capital management, including the optimization of the cash conversion cycle (CCC), is essential for maintaining financial health and driving business success. In this guide, we'll explore the intricacies of working capital, delve into the significance of the cash conversion cycle, and elucidate best practices for working capital management to enhance business performance. Definition of working capital. Working capital represents the difference between a company's current assets and current liabilities. It encompasses the funds available for operational needs, including cash, inventory, accounts receivable, and accounts payable. Components. Current assets. Assets that can be converted into cash or consumed within 1 year. Current liabilities. Obligations due within 1 year, including accounts payable, short-term debt, and accrued expenses. Working capital ensures the smooth functioning of daily operations, enables timely payment of obligations, and supports growth initiatives. Maintaining optimal levels of working capital is crucial for financial stability and operational resilience. Working capital management. The primary goal of working capital management is to strike a balance between liquidity and profitability. It involves optimizing the level of working capital to minimize idle resources while ensuring sufficient liquidity to meet operational needs. Key strategies. Cash flow forecasting. Regularly forecast cash inflows and outflows to anticipate working capital requirements and mitigate cash flow gaps. Inventory management. Streamline inventory levels to minimize carrying costs, reduce stockouts, and improve cash flow. Accounts receivable management. Accelerate cash collection by implementing efficient invoicing, credit policies, and collection procedures. Accounts payable management. Extend payment terms with suppliers strategically to preserve cash flow without jeopardizing supplier relationships. Optimizing the cash conversion cycle. Minimize the time it takes to convert inventory into cash and then into accounts receivable, thereby maximizing operational efficiency and cash flow. Performance metrics. Working capital ratio. Compares current assets to current liabilities to assess liquidity and solvency. Days sales outstanding. DSO. Measures the average number of days it takes to collect accounts receivable. Days inventory outstanding. DIO. Evaluates the average number of days inventory is held before being sold. Days payable outstanding. DPO. Calculates the average number of days it takes to pay suppliers. Cash conversion cycle. CCC. Represents the time it takes for cash to flow through the operational cycle, from inventory purchase to cash collection from customers, and is calculated as DIO plus DSO minus DPO. Benefits of effective working capital management. Improved liquidity. Efficient working capital management ensures adequate liquidity to meet short-term obligations and capitalize on growth opportunities. Enhanced profitability. Optimizing working capital reduces financing costs, improves cash flow, and enhances profitability. Risk mitigation. Maintaining optimal working capital levels mitigates financial risks, such as cash flow shortages, inventory obsolescence, and credit defaults. Stakeholder confidence. Sound working capital management instills confidence in investors, creditors, and other stakeholders, signaling the company's financial stability and resilience. Challenges and considerations. Market volatility. Fluctuations in market conditions, customer demand, and supplier dynamics can impact working capital requirements and necessitate proactive management. Seasonal variations. Businesses experiencing seasonal fluctuations in demand must adjust working capital strategies to accommodate peak and off-peak periods. Credit management. Balancing credit terms to attract customers while minimizing bad debts requires careful credit risk assessment and monitoring. Conclusion. Working capital management, coupled with the optimization of the cash conversion cycle, is a critical aspect of financial management that directly impacts a company's liquidity, profitability, and resilience. By implementing sound working capital management practices and leveraging performance metrics, businesses can enhance their financial health, capitalize on growth opportunities, and navigate economic challenges effectively. By prioritizing working capital optimization, businesses can position themselves for sustained success and long-term growth in today's competitive business landscape. Useful expressions. Optimizing working capital helps maintain liquidity and support day-to-day operations, ensuring financial stability and resilience in the face of challenges. Effective working capital management involves balancing liquidity and profitability to enhance cash flow and maximize operational efficiency. Streamlining inventory levels and accelerating cash collection are key strategies for improving working capital management and strengthening financial health. Monitoring key performance metrics such as DSO, DIO, and DPO enables businesses to assess and optimize their working capital utilization. Strategic accounts payable management can help preserve cash flow while maintaining positive supplier relationships, supporting effective working capital management. Forecasting cash flows and anticipating working capital needs are essential components of proactive working capital management strategies. Optimizing the cash conversion cycle can lead to faster cash flows and improved operational efficiency, driving overall business performance. Balancing current assets and liabilities is crucial for maintaining optimal working capital levels and ensuring financial stability in the long term. Effective working capital management is vital for meeting short-term obligations, seizing growth opportunities, and enhancing shareholder value. Managing working capital effectively requires a comprehensive understanding of cash flow dynamics, inventory management, and accounts receivable, payable processes. Continuous monitoring of working capital metrics allows businesses to identify areas for improvement and implement targeted strategies for enhanced efficiency. Proactive management of accounts receivable can help reduce DSO, accelerate cash inflows, and improve overall working capital position. Striking the right balance between liquidity and profitability is the cornerstone of effective working capital management in any business environment. Efficient working capital utilization enables businesses to seize opportunities, navigate challenges, and maintain resilience in dynamic market conditions. Implementing robust working capital management practices is essential for ensuring financial health and sustaining long-term growth and profitability. Optimizing inventory turnover and reducing excess stock levels are key initiatives in enhancing working capital efficiency and cash flow. Effective communication and collaboration between finance, operations, and procurement teams are crucial for successful working capital management initiatives. Utilizing technology solutions such as automated invoicing and cash flow forecasting tools can streamline working capital management processes and improve accuracy. Aligning payment terms with cash flow projections and business needs can help optimize accounts payable management and preserve working capital. Regular reviews of working capital performance metrics enable businesses to identify trends, risks, and opportunities for optimization and improvement.